Have you ever felt that intense FOMO when a stock jumps high at the start of the trading day, only to see it crash shortly after? This phenomenon is known as a gap up, followed by a strong sell-off. Today, we're going to dive deep into what's really happening and how you can use this information to make smarter trading decisions. First, let's break down what a gap up is. When a stock opens at a price significantly higher than its closing price from the previous day, we call it a gap up. It might seem like a great opportunity, but here's where things can get tricky. Let's take a closer look at why the stock might sell off after a gap up. Big players, those large institutional investors, often use this initial spike to sell their shares. They've been waiting for this higher price to exit their positions and lock in profits. Once they start selling, it creates downward pressure on the stock price. As the stock price starts to fall, retail traders, who may have bought in at the peak, driven by the initial hype, might panic and sell off their positions. This can push the price down even further, amplifying the sell-off. Now, let's put this into a real-world example. Imagine a stock, let's call it XYZ Corp, opens at 500 rupees after a gap up from 480 the previous day. This jump attracts a lot of attention, and the price quickly rises to 510 rupees. However, soon after, the price starts to drop back towards 500. Here's what's happening. The big players who bought XYZ Corp at 480 rupees are now using this opportunity to sell their shares at the higher price of 510 rupees. They're taking profits, and this selling pressure causes the stock to drop. As the price falls, retail traders who bought at 510 rupees may start panicking and selling off their shares, which pushes the price down even more. Now let's consider another scenario. After the initial drop, XYZ Corp's price starts to fall more slowly, settling around 485 rupees. This slower decline might suggest that the intense selling pressure is easing and some buyers are beginning to step in. So, what should you do in this situation? Here's how to approach it. If the price is falling rapidly, like the initial sharp drop, it's usually best to avoid buying because the stock could continue to decline sharply. If the price is falling slowly, like a gradual decline, this might indicate that the selling pressure is easing. Use this opportunity to perform technical analysis. Look for key support levels where the stock has bounced back in the past. For XYZ Corp, if 480 rupees has been a strong support level before, it might be a good entry point for buying as the stock could find support and start to recover. Think of it this way. When big players are aggressively selling, it's better to wait. But when the decline is more controlled and gradual, look for a good entry point where the stock shows signs of stabilizing. Understanding how big players and retail traders react to price movements can give you a significant edge in the market. If you found this explanation useful, give us a thumbs up and subscribe for more detailed trading insights and strategies. Thanks for watching.